Now it will leak. Okay? I'm not talking least. Same like onion. Onion family. You call it green onion?
لا بس الاخضر يعني سيلز
So we don't talk about leaks, we talk about lease. Lease is a facility. Lease is by the way, how many of you have come across the word lease or experience working with lease? Show of hands. Yes, sitting. What is this? Or have you come across? Have you read somewhere? Don't tell me just now I read. Lease agreement. Lease agreement. Okay. So this is an arrangement for a facility. When I say facility, that can be, as you said, from landlord or fund provider also. You call it, there are so many different fund providers, finance institutions, bankers, and so on. So it's a facility for the business to operate with certain ease in order to avoid any operational difficulties, and the organization is not fully equipped with necessary funds or capital, and they don't want to go for loan. So then they go for lease. So lease is actually an arrangement for securing a facility. Facility could be in terms of physical infrastructure, in terms of operating assets, in terms of working capital also. I tried to club all different examples under these three headings. So, in order to arrange a lease or to have a lease arrangement, there are different parties involved in this. For a lease arrangement, you have lessor and you have lessee. How many of you know that dog, lessee? Anyone know that dog? There's a drama, an American drama called Lessee.
So you have like
Yes.
just in the mouth thing.
Exactly. So not that dog. So it's Lessee here. And you may sometimes we may also have another party dealer. What happens normally, the lessor normally do not come into any business involvement. Initial involvement starts with these two parties. Suppose the lessee is Mr. A. He needs a car, and then he approaches the dealer. he approaches the dealer asking to buy the car. But the lessee does not have enough cash upfront to pay for in buying the car fully. So then lessee what he does, you call him lessee. He's just an individual. It could be a business person or a business or an individual or anything. When he approaching a dealer to purchase a car, let's say car cost is 80,000 riyals. Qatari riyal 80,000, for example. And he approaches it, the dealer says, okay, we find showroom, these are the cars available, choose one. He chooses. Then he goes to the office and he says, look, I only have 5,000 riyal in my hand and I still have the car, why not? So there is a team helping you approach them. At that point of time, this Mr. A becomes a lessee. And they say that, okay, you go and approach somebody called lessor. Then do you understand who is lessee and who is lessor in this diagram? Who is lessor? Lessor is the finance provider or facility arranger.
Landlord is one example.
Landlord is just one example.
Yes.
Bank. In Qatar we have this First Finance, Al Jazeera Finance, or any bank, commercial bank or Doha Bank or QNB or any of these. So then he approaches the lessor. Then the lessor then sets certain conditions. Okay, if you fulfill 1, 2, 3, we will help you get your car. So they give set of documentation. So this fellow has to bring or comply with those required documentation and then submit or furnish those documents to lessor. And then after they successfully receiving it, then what they do, they create a relationship between lessor and the dealer. What happens? The lessor instructs the dealer, release the car, we will pay you. So then purchase order and the payment mechanism takes place between lessor and dealer. After that is done, then the car will be physically delivered to lessee or Mr. A. Now, after the transaction completed, will there be any financial relationship between lessor and dealer? Sorry, lessee and dealer? Kalas, he received the car and then he went off. He assumed he don't need to pay anything or unless insurance or some other trivial payments. Apart from that, there is no any immediate payments he need to make. But then you need to think about recording the transaction in the books of lessor and in the books of lessee. This was the old school of thought when it comes to lease, and that's how the understanding of the lease has been developed. And then they went on to explain there are two types of lease, as I written here. There are two types of lease. One is finance lease, other one is operating lease. Based on the previous scenario, one good example for operating lease is almost a rent-a-car. Now this almost a rent-a-car, what they do, they have fleets of cars. Who is the legal owner of the cars? In Al-Mukta rent-a-car, they have, let's say, 100 cars parked outside there. You also have them. Then why I go to Al-Mukta? The Sulaiman rent-a-car, right? Haider rent-a-car.
Yeah.
Haider rent-a-car.
That's
So,
close of it.
close colour. Yes. Past tense. You had. So, the fleets of car, the legal ownership, or forget the legal ownership, ownership in substance, in whose books? In the books of Haider, Penta. Any customer like you and you, me or someone takes one car, he drives the car for the next 3 days or next week or 2 weeks. Can he become the owner of this car?
No.
No. So this arrangement is what we call operating lease. In operating lease, what happens? You consider that there is a rental income. To whom? To the rent-a-car company, in other words, the lessor. For the person like me, you or someone who has taken the car, for him the payment he makes is simply an expense. That's it. Whereas when you go to finance this, story is entirely different. But now they have reclassified, or they've gone out with this classification and they come up with new classification. So before I go further, I would like to know whether I need to discuss anything else. Okay, one important aspect or point that I think I have discussed in other sessions also, but still I would like to know whether you still remember this. Substance over form. It is very important to have this understanding when learning leases. What is substance over form? I discussed this or not? I did. Okay.
To ask, you remember?
You all remember this or not? Anyone know remember? Kneel down for half an hour. Remember? Mom. Yes, Madam ChatGPT. Remember? Yes. No. Habib Mansur. Faham Tali?
فهمت or remember?
Not faham.
No. Remember?
Remember or فهمت? Because different. فهمت I understand.
Yes.
You don't say anything to understand that. But as remember, I don't know this.
You don't know this. No. Very clear. Yes, Amir. Very good.
5 minutes.
Let's say, why we put this example? Mr. A has a car. As per my definition, this is a car. And he has a friend, Mr. B. He goes on vacation. Mr. A goes on vacation. Car is parked in his garage. They are very close friends. Mr. A and Mr. B are very close friends. So Mr. B approaches Mr. A. Says that, look, you are going for 1 month vacation. You are keeping the car for 1 month in your garage. Give it to me, I will use it. So he's the close friend, he can't do anything, so he gave it. So he went away, he took the flight and then Masalam. Now he started using the car. During this 1 month, all the expenses relating to the car, who should bear? Petrol. Can the Mr. A come back from his country to pump petrol to the car? No. Who should do this?
B.
Mr. B should do this. And AC, music system, sunroof, luxury of four-wheel drive, who will enjoy?
B.
Mr. B will enjoy. And in case, as is, there is a sentence saying like this in English: speed thrills, but it kills. Also, speed kills, but it. So maybe he is following the second line. He is driving the fast in Samal Road, and Subhanallah, he met with an accident.
Insurance.
Sirji, you have to allow me some time. Good morning. I'm in a lecture. I'll call you back. Thank you. So, in that accident, now let's not talk about insurance. Okay? In that accident, who should be repairing it? Hopefully, nothing happened to Mr. B and only damage took place to the car. Then those repairs should be done by Mr. B. See, in this particular asset, legally owned by whom? A legal owner.
A.
Whereas, all the, now, from our first time discussion of definition of asset, we said that assets should be resources which should bring economic benefits in the future as a result of past transaction and or events, and which are owned and or controlled by the user. Now, according to that line of definitions or words in that definition, who is receiving the benefits in this particular example? Mr. B is receiving the benefits in this particular example. He had to undertake also all connected or attached difficulties like pumping petrol, maintaining the car, changing tires or repairing the vehicle, all this. So both risk and rewards are with whom? With accordingly, based on the theory of substance or form, the asset should be booked in the books of Mr. B. So you will open set account, you will record it here, and then you will open a liability account, you will record it here. Now when this fellow comes from vacation, he may get heart attack. Oh my goodness, my asset has been booked in US books. So for the sake of example, I wrote this, but however, I believe now you understood this, and please do not let me repeat the same explanation again. If I had to, I may have to ask all of you to get out of the class. I will be serious also. So please remember this. Very important point. So substance over form, which is one of the principal factors for us to understand the leases. Clear? Let's now move to we will talk about certain definitions. We will talk about how we identify leases. We also talk about in the books of lessee, what are the accounting, and we also talk about in the books of lessor, what are the accounting, and there is something called sale and lease back. Also, we will discuss. Now, this particular standard issued in 2016 applies annually, reporting periods beginning on or after 2090. Very fresh. Now 2024 now. Just 4 years. Still people are learning how to incorporate the new standard in our financial statements. And this will comply or this will coincide with the definitions that you found in conceptual framework of financial reporting. A lease is a contract or part of a contract that conveys right to use an underlying asset for a period of time in exchange for consideration. Let's analyze this definition. They say this is a contract. It may not be an entire contract, it could even be a part of contract. In a complete contract document, you may have clause 3 numbers, clause 1, clause 2, clause 3, which talks about this. And what you find there, you find something called right of use and underlying asset. Now, you need to understand right of use asset. Now, typical example, if you, for example, this one of the towers in College, let's take any tower, Albita Tower example. You go and lease an office and you sign a contract for 3 years. Underline the word, you sign a contract for 3 years. 3 years meaning exceeding 12 months. So now you have allocated one particular space for you to use it. So you have the right to use that space. Since the concept of the right you have to use that place, it is also considered is part of your property, plant and equipment. It becomes one of your assets. And this asset is amortizable or depreciable, either term you can use it, and for the over the period of your lease time. During that period, you got to recognize one side of the books as an asset. You name it as right of use asset. On the other side of the books, you recognize a liability. Debit an asset, credit a liability. Now the question of, if I sign up a contract for 12 months, will I still be doing this? Then answer is, the IFRS 16 went on to say that you have 2 different types of leases. One, short-term lease. The short-term lease will not fall into this discussion. So all the lease payments you pay under the classification of short-term lease, you just consider as expense. Alas. Profit and loss account. So take it to profit and loss account. Profit and loss account in Arabic? And you just debit lease expense, credit cash or credit bank or credit payable. But if it so happens that your lease contract is 18 months or 24 months or 36 months or so on, then the question of right of use asset comes. Yes, Mr. Mansoor, clear? It must board. And you see, and also they use the word for an underlying asset. Now, it is not an asset, it is underlying asset. Now, this building, you see, it's unfair now. The lessor has put lot of efforts to put up this building of 40-floor building. He proudly recording in his books under PP. He is recording building debit, cash credit. He recorded. He doesn't know that the lessee also going to book the portion of the asset. For the lessee, it is not the building that is an asset for them. It is the permission or the permission to enjoy the amount of benefits and luxuries that is dedicated to the lessee because of this contract. Therefore, you in substance, now you see the word substance comes into play now. In substance, enjoying certain attributes which are falling under the definition of PPE. Therefore, you have to recognize that as an asset. So that's what we call it underlying asset. For a period of time, extend for what? Extend for consideration. What is the consideration you give? I believe you all know the meaning of the term consideration. Arm elect.
Yes or no?
Yes or no?
You know or you don't?
Naam Walla. Yeah, Ustad Mansoor.
Yes, boss.
See, today you are spotlight for me. Kalas, yes. Because straight focus. Consideration. What is the meaning of that word? Remember we discussed consolidation and we talked about purchase consideration. In literal English meaning, payment. Simple as that. Just think it's payment for a period of time in exchange of what? Payment. So you make some lease payments, lease rentals. Accordingly, then this arrangement is known as lease. Clear? For you to define a lease, there should be a contract, there should be right of use asset, there should be consideration. Is that clear? Then the lessor is the entity that provides the right of use asset. Who is lessor? He is the person who is providing this permission to have the right of use asset. In exchange, receives consideration, yes, payments. Who is the lessee? Is the entity that obtains use of the right of use asset and in exchange transfers consideration. The right of use asset is the lessee's right of use and underlying asset over the register. So in whose books you will see right of use asset as an asset in the books of lessee. Is that clear?
Liability side?
Huh?
Liability?
See, if you recognize the asset, other side of the coin is the liability. So you debit right of use asset and you credit this liability.
Expense. Expense.
Oh, expense we will discuss now. What type of expense you gonna have? You're gonna have later. If it's a lease rental, you're going to pay monthly rental. And if this monthly rental for next 36 months, there is a bit of interesting calculation comes in. We will talk about it. Now, how to identify a lease? A contract contains a lease if it conveys the right to control the use of an identified asset for a period of time in exchange for consideration. See, the use of language is very beautiful here. But they say the contract contains a lease if it conveys the right to control the use of an identified asset. I have identified this piece of asset. And that piece of asset for a period of time in exchange for consideration. This to be the case, IFRS 16 says the contract must give the customer the right to substantially all the identified assets, economic benefits, and the right to direct the identified assets use. Now here, for these purposes, identified assets will be underlying assets. Now, you have had third floor of the building. You have signed up for 36 months. Fine. And if you come and say that, okay, I'm going to change the paint of entire building, that's not allowed. Here, what they are saying is the right to substantially all the identified assets, economic benefits. Identified assets is only this portion, not the entire building. Got to remember that. To direct the identified assets, the way you want to use this particular space is no problem. The landlord is not going to creep his nose and find out what's happening here, provided all legal activities are taking place. Otherwise, he will leave you to do your business. So, then in your books, you recognize this particular portion as right of use asset. Is that, am I making myself very clear?
Yes.
Yeah, Habib also.
Yes, boss.
Very good. The right to direct the use of an asset can still exist if the lessor puts restrictions. The lessor can put restrictions on its use within a contract, such as by capping the maximum mileage of a vehicle or limiting which countries an asset can be used in. Now, if you go to hire a rent-a-car, they say that per day you can only use for 150 kilometers, example. But if you've taken the rent-a-car for the next 2 years, the first condition should exceed 12 months. The duration must be more than 12 months. Then still the lessor can have conditions. Yet you can still recognize assets in the books of lessee. These restrictions define the scope of a lessee's right of use, rather than preventing them from directing use. See, restrictions define the scope of lessee's right of use rather than preventing them from directing use. IFRS 16 says that a customer does not have the right to use an identified asset if the supplier has the practical ability to substitute the asset for an alternative and if it would be economically beneficial for them to do so. Understood this or not? Now, in this case, customer, who is customer now? Lessor or lessee?
Lessee.
Lessee is the customer. Customer does not have the right to use an identified asset when, if the supplier, who is supplier now?
Sir.
Lessor, has the practical ability to substitute the asset. He can bring another car. Then he can't control the existing car. He has to use the car and take the new car for an alternative, and it would be economically beneficial for lessor to them to do so. Is that clear? These restrictions define the scope of a lessee's right of use rather than preventing them from directing use. IFRS 16 says that a customer does not have the right to use an identified asset if the supplier has the practical ability to substitute. And this is the same point that we talked about here. We'll try this example. Identifying this. A enters a contract with N to use some space in its lab to screen clients' sample for a 3-year period. You see? 3-year period. A owns the lab equipment. So A hires what? only the space. Lab equipments are owned by whom? A. Space owned by N. The contract stipulates the amount of space and states that space may be located at any one of several labs within the hospital. So probably N is like a hospital. The lab operator can change the location of the space allocated to A at any time during the period of use. And the cost that N would incur to do this would be minimal. There are many areas in hospital that are suitable for the lab operations. Does the contract contain this or not? What do you think? Allow me to decide. Yes. Now, the contract does not have a lease because the contract is for space in the lab and the lab operator has the practical right to substitute this during the period of use. See, the lessor has the right to change it. Whereas once you give, like for example, if you go to Akli hospital, you see one lab space and that must be fixed space. And every day you come, okay, you go and change that place to this area, that area like this. Then it is not the lessee is controlling it. The lessor is controlling it. The contract is for space in the lab and the lab operator has the practical right to substitute this during the period of use because there are many areas available in hospital that would meet the contract terms providing and with a practical ability to substitute. The lab operator would benefit economically from substituting. The lab operator is lessor or the other company is lessor? The lab operator is lessor, right? And he is the one who is going to have economical benefits. When he is going to have economical benefits, it is not a lease agreement or arrangement with that company appeal, right? So this would allow the operator to make the most effective use of its space available, thus maximizing profits to lessor. A enters into a contract with you, the supplier, to use a specified ambulance for a 5-year period. You has no substitution right. You has no substitution right. During the contract period, A decides that patient will be transported when the ambulance will be used and to which hospital it will drive to. However, there are some restrictions specified in the contract. Those restrictions prevent A from carrying suicide bombers as patients or from driving the ambulance into areas where terrorism is a risk. What do you think? Now, previous example, it was very clear those restrictions are fair by the lessor. No, sorry, it's not fair. And it is for the personal benefit of the lessor. So then you cannot classify that as a disagreement. But here the case is different. What do you think here? You operate the and maintains the ambulance and is responsible for renewal of the ambulance vehicle. Particularly, A is prohibited from hiring another driver for the ambulance and from operating the ambulance itself during the term of the contract. Does the contract contain a lease? What do you think? What's the corrective answer? Okay. A has the right to use an identified asset for a period of 5 years. Cannot substitute for a period specified ambulance for an alternative. A has the right to control the use of ambulance throughout the 5-year period of time because number one, it has a right to obtain substantially all of the economic benefits from use of ambulance over the 5-year period due to its exclusive use of the ambulance throughout the period of use. Therefore, there is a lease arrangement. Double entry, we discussed already. What is the double entry here? You debit right of use asset and you credit
This
liability. Initial, how do you determine the lease liability initially? State that lease payments include the following. What are it includes? All these, fixed payments, variable payment depend on an index or rate, present value amounts to expected to be payable under residual value guarantees. I'll discuss about this. Present value option to purchase the assets that are reasonably certain to be exercised. Termination penalty. The lease term reflects the expectation that these will be incurred. What do you mean by this? See. Now, if you sign up a contract for 3 years, and that means 36 months. Each month, you pay a rent of, let's say, 25,000. So, this will be like, what's the total? Can someone tell me the answer?
900,
900,000?
I think.
MashaAllah.
No, bro.
MashaAllah.
900,000. Now this 900,000 we are not going to receive at one shot. How are we going to receive? Month 1, month 2, month 3. Like this. Then first year 1, 300. Year 2, 300. And year 3, now we are in year 0. What you need to do, you need to calculate something called present value at year 0, and that will be your right of use asset. And this includes, this 25,000 includes all what they are saying here. See, fixed payments, variable payments, sometimes you need to pay a commission to the person arranging the lease agreement, or you need to pay to the lawyer 3%, 4% stamp duty, custom duty, some government legal payments. And these all put together. Termination penalties are if you after like 18 months you need to vacate the building, then what is the arrangement? 2-month rent, 3-month rent, something like that. So all this you need to incorporate in arriving this calculation. Clear?
Clear and real.
How do you account the lease liability? Now we talked about it. Account for the lease liability after the IFRS 16 state that lease payments include the following. The carrying amount of the lease liability is increased by the interest charge. The interest is also recorded in the statement of profit or loss. Now, if you have interest because of the lease liability, debit finance cost, that interest expense, and you credit that to lease liability. The carrying amount of the lease liability is reduced by cash payments, debit lease liability, and credit cash. Do you understand that double entries or not? See, I have the lease liability here, and I have the right of use asset here. I debit here and I credit here. Now I have interest. What I do? I have interest on the lease arrangement. So I debit interest here and then I credit lease liability here. That is the entry first. Second entry, when I pay cash, monthly I am paying cash. So debit liability and credit cash. Yeah. measurement of right of. The right of use asset is initially recognized at cost. IFRS 16 says that initial cost of the right of use asset comprise the amount, the initial measurement of the lease liability as above. We discussed that. Lease payments made at or before the commencement date, initial any direct cost. Meaning, just before the commencement of the lease, if you had to incur additional costs related to the lease arrangement, that also you need to factor into this. The estimated cost of removing or dismantling the underlying asset as per the condition of the lease. You remember we talked about IAS 37 and we talked about renovation cost. Or at the end of 5 years, you have to the decontamination cost, clean up the site. Same thing. If you had to do some removing and dismantling cost after 5 years, you have to recognize right now. Subsequent measurement of right of use asset. After the initial measurement, initially at what we measured? At cost. Subsequently, the right of use asset, this means that is measured at its initial cost less accumulated depreciation and impairment losses. Now, one thing I forgot to tell you, now this one, the right of use asset, you should depreciate. Over how long? What is the life of that asset? The lease period. There is no question of useful economic lifetime, only the lease term. So, when you depreciate, double entry, debit, depreciation expense, credit, accumulated depreciation. So, every year the accumulated depreciation will increase. And also possibility of any year you may have impairment. So, accumulated and impairment losses, depreciation and calculated liability. If ownership of the asset transferred to lessee at the end of the lease term, depreciation should be charged over the assets remaining useful economic lifetime. Only when you transfer the ownership at the end of the lease term. Otherwise, this will charge over the shorter of the useful life and the lease term. What do you mean by that? Suppose the useful life is 3 years, lease period is 5 years, you should only charge for the initial measurement, the lease term. To calculate the initial value of the liability and right of use asset, these must be considered the length of the lease term. IFRS 16 says lease term comprises of non-cancellable periods. Periods covered by an option to extend the lease if reasonably certain to exercise. You cannot cancel this. You can only extend this period. Periods covered by an option to terminate the lease if reasonably certain not to be exercised. That is cancelable possibility. So, you have the total lease term should be both cancelable and non-cancelable. A lessor must classify its, now lessor's accounting, leases as a finance lease or operating lease under the books of the lessor. IFRS 16 provides the following definition. A finance lease is a lease where the risks and rewards of the underlying asset substantially transferred to the lessee. Now, in the books of the lessor, finance lease definition still remains. In the books of the lessee, no more. Operating lease is a lease that does not meet the definition of finance lease. At the inception of the lease, lessor present assets held under finance lease as receivable. So what he does is, he debits receivable and he credits to income or credit to asset, in other words. He transfers from, let's say, I have a motor car and I lease to you. So until I lease to you, the motor car belongs to me. So in my books, that's the asset, motor car asset. So I credit motor car asset and then transfer to lease receivable. Then subsequent treatment, carrying amount of the lease receivable is increased by Now what happens is, now you see that interest income. Interest income, let's say you have 100 for that month. Double entry, I debit to lease receivables, credit to profit and loss account as income. How to classify lease by lessor? IFRS 16 states that the lease is probably a finance lease if one or more of the following apply. Ownership is transferred to the lessee at the end of the lease. The lessee has the option to purchase the asset for less than its expected fair value, meaning nominal value. Very small amount. At the date of option becomes exercisable and it is reasonably certain that the option will be exercised. Meaning, today I am signing up a lease agreement. After 5 years, I am using the car for 5 years. End of the 5th year, end of the completion of the 5th year, then let's say the normal cost of the car is 100,000. I buy the car for 5,000 there. Nominal value. And today we confirm that after 5 years, you will still take in the car. That's all what they are saying here. Clear? How to classify lease by a lessor? The lease term, including any secondary periods, is for a major part of the asset's economic life. Now, see, for example, you renting a office space. You renting it for 5 years. Now, what do you think a life of a building? How many years? Minimum 20. Possible 50 or 20 also okay. 20, 50, 100 like this. Now, if you compare 5 years out of 20, what is the percentage? 25%. It's not 50 or 60 or 70%. It's smaller time compared to the total life. But if you're hiring a car, you have kept the car for 4 years. So what is the normal life of a car? 5 years or 10 years. If you kept it, see, then 40% or 50% or 80% of the time you have used it. So that's what they are saying. If the major parts of the asset's economic life, if that asset is with the lessee, then that becomes a finance lease for lessor. At the inception of the lease, the present value of the lease payments amount to at least substantially all of the fair value of the asset. I'll explain this. Let's say my lease payments. I take all my lease payments for 5 years. And then you remember the calculation I have done here. This calculation. See? So this is what we call present value. This present value. And I will also go and take the fair value of the asset. What we are saying is, this answer must be more than 90% of the, meaning greater amount of the fair value should be the minimum lease, present value of the minimum lease payments. We call it MLP, minimum lease payments. The lease assets are of a specified nature so that only the lessee can use them without major modification. Now, for example, if you go to Rasa Musuntas, Qatar Electric Water Company has gas turbines. On the outset, we may think it is owned by QEWC. Actually, not. It is owned by another entity. They have leased it out to QEWC. But QEWC can only use this. It's a special equipment, gas turbine. If the lessor who supplied it take it out from that plant and bring it to Doha, no use. So without major modification being made, the lessee will compensate the lessor for their loss if the lease is cancelled. Lessee can continue the lease for a secondary period in exchange for substantially lower than market rent payments. I also have the same example with the Rasa Mukuntas. There is one plant, normal life was 25 years, over. Then there was a negotiation to terminate or to continue. Then they went on to agree for continuation with a very little payments. Still that plant is there under negotiation to scrap it because the wear and tear is fully over. So, sale and lease back. Now what is sale and lease back? To determine whether the transfer of an asset is accounted for as a sale, an entity applies the requirements of IFRS 15. We will discuss in the next class for determining when a performance obligation is satisfied. Only a certain performance obligations are satisfied, then only I will consider this is a sale. Small example, I buy this chair. For me to say that I have purchased this chair, I should be able to control the use of the chair. Then that is one tick of the performance obligation. If an asset is transferred, satisfy IFRS 15's requirement to account it for sale, the seller measures the right of use asset at the proportion of the previous carrying amount that relates to the right of use asset retained. Meaning, from the total right of use asset, that portion can be retained by the seller. Then accordingly, seller only recognize the amount of the gain or loss that relate to the rights transferred to the buyer. Not the asset, but the rights. If the fair value of the sale consideration does not equal the asset's fair value, or if the lease payments are not market rates, the sale proceeds are adjusted to fair value either by accounting for prepayments or additional. It is not a sale then. If the fair value of the sale consideration does not equal to asset's fair value, or if the lease payments are not market rates, then the sale proceeds are adjusted to fair value either by accounting as prepayments or something called additional financing. Now, finally, objective of IFRS 16 disclosure is for information to be provided in the notes that together with information provided in the statement of financial position, statement of profit or loss, and the statement of cash flows gives a basis for users to assess the effect of that is having. Thank you so much. And next class, IFRS 15, revenue from contracts with customers. So then the next Sunday we will start financial institutions.